Thanks so much for taking time out of your busy schedules to join us for today. We promise to keep it fast-paced. We're going to keep you here for a while, for those of you that can stick with us. Just to give you guys a little bit of insight into how the day is going to go. Steve is going to kick off the Arquitos Capital annual meeting here. I'm going to do a presentation for you guys. We'll open it up for some Q&A as well. Then Dave Waters will follow with the Alluvial Fund, and then Keith Smith with Bonhoeffer Fund. Kind of same format, presentation, Q&A. We'll break for a little bit. We're going to bring in some catered reception. We'll have a little break, and then we have kind of a less formal evening program. We have some featured, a big announcement that we're looking forward to sharing with everybody, and then a kind of an informal talk with our featured portfolio managers that we're delighted will be able to join us. So with that, I'll kick it over to Steve. And
so to kind of carry on what Jessica mentioned, I'll add some specifics to it and a few introductions. So first of all, we've done kind of these investor, say annual meetings, at least Keith and I have in previous years, and we thought this would be a good idea to get everyone together at once. I know it's kind of a long day, so feel free to step out. We have a few private rooms if you need to take a phone call, if you want to step outside, grab a cup of coffee or something along those lines, perfectly fine. And we wanted to break it up a little bit with a happy hour and a little bit of a different approach. So we have our investor kind of annual meetings this afternoon, and then at 5 o'clock and beyond, we'll have kind of a fireside chat type of situation. Maybe we'll get a little Yule log or something in here in the background. But more casual and less maybe at 5:30, less stocks, more of our backgrounds and how we got into investing and things of that nature. The most exciting thing, I think, all of this is exciting for me, of course, being involved with Willow Oak, but a real highlight, I think, is the announcement that we're going to have at 5:30, the new fund that we're partnering with, and might be, for those of you in the audience, maybe not a very good kept secret, because you may have talked to these guys already here, but we'll make a formal announcement and bring them on stage, and we're excited to be partnering with them, with Willow Oak, and those who shall not be named until 5:30. So with that, what I introduced is kind of a few people behind the scenes here. Jessica, who you've heard from, and most of you probably see her as a primary contact for our investors and those who reach out to the company, to the funds. Elisa Sanchez is in the back there. She handles our back office. So she'll be behind the computer working while we're having fun here. And of course, we have a team kind of who are not here as well, other members of Willow Oak and the parent company, Enterprise Diversified. And Keith, who of course we'll hear from later on. I'm going to introduce Keith as a director of Enterprise Diversified. Thomas Brazil, who's also a director, will be here probably any minute, sometime this afternoon as well, so make sure you have an opportunity to speak with him. He came in from London for a few days for this. Jeremy Deal is unable, he's in Europe as well, and then Aaliyah Kleinhammer is our other director. And then a few advisors as well. So we're really excited about the network of Willow Oak, and that's for the funds themselves, so those associated with the public company, the investors, and other people who are followers and advocates of us. And so we have a couple great advisors to Willow Oak as well. Scott Miller is one of them here with Greenhaven Road. We'll have him come up on stage later. And Parag Shah, who should be coming this afternoon as well, who's with Arena Investors. And then Andrew Wynn is in London, who runs a fund called Fairgreen Capital and was an allocator through BayWim. So we're really proud and happy to have those people associated with Willow Oak. Certainly it gives us an opportunity to kind of consolidate the work we've done over the last 2 years and begin kind of a growth phase for the company, the subsidiary, and also the public company overall. So as Jessica mentioned, with the schedule, I think we should be in good shape. Again, cocktail reception at 5, our special announcement at 5:30, and then we'll have a couple hours after that with a fireside chat that I'm excited about. We'll bring up all the portfolio managers, including Keith, Thomas, Scott, myself, Dave, and everyone who's kind of picking stocks. And then finally, I always want to acknowledge those who've traveled so far. We have someone from Singapore. We have, I think, someone's coming in from Spain, has not arrived yet. And DC, Austin, other places like that. A few people who came all the way from Connecticut. Thank you for coming here. So welcome, and we promise to make the day worthwhile. Okay, so first presentation of the day is Arquitos. For those of you who don't know me well, I'm the portfolio manager of Arquitos Capital, as well as the chairman of Enterprise Diversified, the parent company of Willow Oak. I started Arquitos in 2012. We have an onshore fund was started in 2012, and then a BVI offshore fund launched about a year and a half ago. So Arquitos Capital, we're an unconventional hedge fund focused on a small number of unusual companies. Take a concentrated approach, bottom-up, value-oriented, and really, in terms of acquisitions of the companies, looking for special situations and some sort of company-specific issues. And then hopefully we can find those companies that have long-term growth and can transition to those types of long-term growth companies. So that's what I look at. Arquitos is supported on the operational side by Willow Oak and Jessica and Lisa and their team. So that allows me to focus on the investing side, and they can handle everything else associated with the company, investor relations and compliance and back office and all of those types of things. We, Arquitos, own approximately 30% of Enterprise Diversified. We took over the company in 2015. So the general approach is, the general companies, type of companies that we're interested in have like the high level of aligned interests. I think that's the best way to look at it. So I look at it that, I have a significant portion of my net worth in Arquitos. I think that's any hedge fund manager, portfolio manager should do that. And I'm looking for companies that have that same level of alignment. So some sort of high insider ownership, a lot of board ownership, good capital allocators, incentive plans, and other things like that at the management level, where you're looking for an outsider type of decision maker, capital allocator. It doesn't guarantee that they're going to be successful, but at least it makes sure that they put their money on the line right alongside you. Because as a passive investor, and I've realized this even more being part of the public company the last few years, it's how much goes on behind the scenes that we don't, the public as a passive investor would never know about. And so you have to build trust over time with those decision makers and capital allocators to make the right decisions, to have the types of values that we want to invest in. When they have their money where their mouth is, that's kind of a prerequisite. From there, in times of distress, I think there's no better person to go to than Winston Churchill. And I'd say Arquitos over the last 18 months or so has been in a period of distress. I had a tough year last year. I've had a bit of a tough year so far this year. So we kind of look to Winston Churchill here. We're probably in the middle of hell or maybe the end of hell, and we want to keep going through it for the portfolio. But with that, I want to kind of describe throughout the rest of the presentation today. I think we're kind of like Great Britain in maybe 1940, right before the U.S. entered World War II. We're kind of at the end of a difficult time period. We're about to kind of be saved by the operational actual success from the companies we own. And I think, over the next 6 months or so, we've got some great opportunities for the market to begin to recognize the value of the things that we own right now, that where operationally they're not kind of getting the recognition that they deserve. So certainly excited about this situation right now with Willow Oak and Enterprise Diversified. And In a couple slides, I'll show how challenging the enterprise diversified position has been for the portfolio. And it'll provide a little bit more background there. But certainly an event like this with some managers who we're associated with and we have a lot of confidence in, and then of course a new fund that we're partnering with as well. And you know, with the team that we've built out there, now's the time to begin to kind of show what Willow Oak is capable of. And also go through some of the other enterprise diversified subsidiaries that have not worked out as well, that have been written down, but still have some cash flow generation potential over time. So the stock prices kind of reflected those difficulties at the other subsidiaries over the last 18 months or so. But you know, it's to the point now where really the value of the company itself is probably not being recognized, the potential of it. But I'm not up here to kind of talk up you know, the company itself. I'm here to say we're confident in the operations. We are confident. We love the team we put together, the partners, the affiliated funds, and you know, we'll let the results show through over the next few quarters, the next year or two. And I know that you know, 10 years from now, we'll look back and really be proud of what we've been able to build at Willow Oak. Next thing is, I mean, our largest position is actually MMA Capital, which again I'll talk about as well. But started buying it about 5 years ago at $12 a share. It's now at about 30 or so, and deserves to be traded even significantly higher price than 30. There's a pathway, a conservative pathway to 20% annualized gains in MMAC over the next 5 years. The final one that I'll discuss today is West Aim. Kind of be a little bit more brief with that, as it's a smaller holding for us. It's been kind of a definition of a value trap in terms of the stock price, but not operationally. I mean, operationally, the company's been performing very well. Book value's been growing over the last well, significant time period, and now they're right at the cusp of having predictable kind of net income, free cash flow generation from Arena Investors, their credit fund. So excited about that. Parag Shah, who will be here later today, heads up the marketing efforts at Arena. So we're hoping, once the market realizes the operational success of our holdings, we'll have a ticker tape parade. We'll get back to the celebrations of 2016 and 2017 for Arquitos. Just ask for a little bit more patience and let you know, we don't want to lose our discipline about the success of the operating underlying aspects of the companies are actually performing. So I pull this one out every few years. The last time I pulled out this slide was when we were in the euphoria stage, probably in, we didn't know this in hindsight, but probably 2017 time period. Right now we might be at that point of maximum financial opportunity, i.e. despondency or depression. But I can say that, you know, on this slide, it's always important to look at it because, you know, in times of real success and in times of real difficulties, that's the time where discipline is most important. And to remind yourselves and myself that risk is not volatility. You know, risk is the possibility of permanent capital loss. And, you know, when you look at that, and, you know, now we're in a situation where you know, look at the holdings and determine, you know, these holdings that we've had that maybe have not performed as well over the last year, 18 months or so, is there a chance of permanent capital loss from that? And is that risk on me, or is there also a risk on kind of the investor base? And the answer to that is yes, to both. On me, it's a matter of making sure that I'm confident and have made, you know, great decisions based on analyzing certain companies, and that have an appropriate margin of safety and all those traditional value-oriented, you know, fundamental views on things. And then on the second side, you know, I need to make sure that I can kind of keep my discipline and emotions in check, and make sure we're focused on the operations of the company and not get overly excited or overly depressed over the stock price itself. Make sure you use volatility as an opportunity and not treat it as a risk. So, and again, certainly with investors and prospective investors and things like that, and this isn't just for Arquitos, but for any investment in a value-oriented fund or fundamental-based type of approach, we want to make sure that we understand what we're getting into. You know, there's going to be cycles here. They don't necessarily match the economic cycle. They don't necessarily match, you know, even the stock price, the stock market as a whole going up and down. I think we all the funds here, we have a benchmark that we reference, but we don't think about it. You know, we're trying to focus on our portfolio itself, and there'll be holdings that do well in any market environment. There'll be some that are a little bit more cyclical. You know, but the point is to make sure that we're making decisions based on the operations of the company and then relative to where the stock price is at that particular time. So I saw this the other day. This is 2012 was when I started the fund, so I just kind of created it from there. This is the SP 500 from 2012 to 2019, smoothing out the volatility. I think it's about a 13.5% return or something like that, which obviously is higher than what it'll be in the future. But if you smooth out the volatility, you know, that's what everyone wants, that's what investors want, that's what I would like in a perfect world. And I'll show in the next few slides that that steady increase, obviously is not what reality actually is, but it also does not optimize your returns. And so if we go here, that's what reality was. The SP 500 actually kind of up and down, and led, you know, reaches the point where it's all the same on the end. But you'll see with more volatility that we can actually get higher returns, higher overall returns over time. So we go to Arquitos here. Arquitos, the orange one is net returns, the green one is gross returns. A lot more volatility, of course. The ups, the highs were higher, the lows were lower, but over time, it's going to be higher. We've been able to take advantage of some volatility. 2015, for example, which the decisions I made in 2015 led to the returns in 2016 and 2017. And then the challenges over the last 18 months or so, you kind of see it brought back down, but we're still significantly ahead compared to the market itself. So on a gross basis, you know, we doubled the market. On a net basis, 50% higher. So here are the returns, and I don't want to kind of beat a dead horse here, but you know, when you think about having a fund over a significant time period, and some of the investors that we look up to over time, you know, Charlie Munger, for example, I was reading in my last quarterly letter, presented the Graham and Doddsville speech that Buffett presented in 1984, and he referenced, you know, referenced Munger, referenced Rick Guerin and others. And for those of you who don't know Rick Guerin, one of the greatest investors of all time, I had a 78% drawdown in the early 70s, and but his record over the time up until Buffett's Graham and Doddsville speech was 33% a year over 19 years. Munger had significant drawdowns as well, 53% drawdown. He was at 20% returns over 14 years. You know, you look at even Manish and Bill Ackman and Bill Miller and others like that, and it's kind of part of the hazards of having the fund and the longevity of the fund, and we're going to go through this occasionally, and so want to make sure we're, you know, we properly set expectations that we're going to have some volatility over time, and certainly the goal for me is to be able to take advantage of it and have the ups in the future years be higher than they otherwise would be because of decisions made in some of the more difficult years. And so I mentioned this is here the returns without enterprise diversified. So if you take out Arquitos without SYT, which is the ticker symbol, and say this does not include August because kind of put these together with a little bit of a rough August as well, down 7%, but SiteStar or enterprise diversified made up about 3% of those losses. In August. But look, we would have been positive, you know, in 2019 without the enterprise diversified position. 2018, we would have been down 14%, you know, instead of 30. That would have been a little bit easier to digest, of course. But look at 2017, look at 2016, and look at overall. If you go down to the since inception and annualized, you want that position in there. And certainly at the price where it's at right now, where the upside potential, the risk reward is certainly higher. The reward aspect is higher, probably than it's ever been during our holding period. And now's the time to own it. And so we want exposure to it. It's about 20% of the fund right now. We want to continue to have exposure to it. We've had a lot of pain in it the last 18 months or so, but overall it was better to experience that pain if you look at the overall since inception annualized numbers. All right, then I always, each year try to kind of remind myself and maybe the investors some of our major drivers. Going back to 2012, certainly there are a couple of positions that reappear over time. ALJ was a big one for us in 2013-14 and then went away, and then was a big loser for us in 2018. ALJ trades at kind of 2 times EBIT right now, so it's an attractive position at this price. Back in, I like to kind of relive some of those interesting stories from 2012. Arctic Glacier was a bankrupt ice company that we did very well on. And through the years, Intra-West Resorts was a major driver for us in a positive way in 2016. In 2015, we had 2 holdings that SWK Holdings, Real Industry, that were difficult for us and that led to the losses in that year. And then, look at 2019, 2018, Enterprise Diversified has been the main negative driver. Unfortunately, Westaim's been kind of a negative driver as well. Again, both of these companies absolutely love to own them at this price. We'll continue to own them. So when you look at the decision making and reflecting on decisions that kind of were made for the portfolio, you can look at mistakes of omission and mistakes of commission. Mistakes of commission, the decisions you actually made, are a little bit more obvious. We can sit in the meetings, we can talk about a company, SWK Holdings, for example, in 2015 that did not work out well. I can talk through my thought process of buying into the company and what my expectations were and what went wrong with it, and why it ended up being a mistake and what I would do differently in the future, et cetera, et cetera. It led to, say, 6% of the losses in 2015. But you never talk about the mistakes of omission, the decisions that you should have made that you didn't make. And my experience, being kind of objective about it in some of my decision making since I launched the fund, is that the mistakes of omission are always greater. And there are things like Belmont. And so Belmont was served to me on a silver platter by Thomas Brazil. And to Thomas's credit, he bet big on the position last year. He did very well for himself. And to my detriment, this was kind of an all-timer mistake of omission, I think, for Arquitos. The biggest mistake of omission I probably ever made in my life. So Thomas, he wrote this up last year. He found some filings that were very interesting related to the founding not majority shareholder, very, very large shareholder for the company, and the founding chairman, which made it seem likely that the company was going to be put up for sale. Did some analysis about the potential buyers, what prices they would be at, and the timing on that. And so it was right up my alley in terms of the things I'm generally interested in. It reminded me a lot of Intra-West Resorts from a few years earlier, and you had an opportunity to kind of buy stock, you had a catalyst, you had some even long-dated option opportunities in there. And I'll let kind of Thomas, pull him aside later today to hear about all the details. I'm sure he'd be happy to share the write-up he did as well. But it's exactly the type of situation that I looked for, and it was really handed to me in an obvious way last September. And unfortunately, I didn't do anything about it. I'd say the mistake of omission probably cost the portfolio 30%, quite frankly. It was that big. It was the type of thing I would have gone pretty big on, both with stocks and options. And obviously would have a significantly different year last year and the beginning of this year if I would have followed through with something that was kind of sitting right in front of my face. But Belmont owns very high-end hotels, Hotel Cipriani. They have different travel services, Orient Express, things of that nature. They own some restaurants and other brands. They ended up getting bought out, kind of exactly following what Thomas had laid out in his research piece. they ended up getting bought out by Louis Vuitton for about $25 a share, which was about 150% above their what the price was when he first wrote it up. Over about it was for a 4 or 5 month time period. So the buyout announcement came 3 months after Thomas's write-up. Thomas and I talked about it quite a bit, and you know, again, I kind of sat on my hands, didn't do anything about it, and it cost us big time. So, you know, there's something to be said here with having a clear mind and you know, an opportunity to kind of sit back and analyze these situations. And when you have an obvious one right in front of you, you have to bet big, and that's the reason for the concentration, number one. And the second thing the reason why I bring it up as an example is because this is the value of the network that we've built over the years here. We've got a lot of great investors, a lot of great portfolio managers, and others who are some individual investors that we talk to, that I talk to and have done for many years. And you know, sometimes you find things on your own. Sometimes you know, I'll find things through certain filings, and then sometimes a friend of yours, you know, a colleague, someone like Thomas, you know, does all the work for you, and you have to own the position yourself, not only buy it, but also own it psychologically in order to follow through. And sometimes you know, you profit from it, and sometimes you sit on your hands like I did in this case. So just as a general reminder about the investing approach for Arquitos, this is not all of our positions, but the majority of our positions have these types of characteristics. We're looking for this balance sheet to income statement investing. And the reason for it is because I think it reduces risk. It reduces that opportunity for permanent capital loss. And it also gives some opportunities that might not otherwise be there. What I'm looking for are strong balance sheets, low amount of debt, obviously the high insider ownership alignment, share buybacks are attractive. You know, I often find companies that are making significant tender offers, so find these through SEC filings and other things of that nature. You know, even large purchases by an insider. Those are the types of things I track on a daily basis. And you want that strong balance sheet for two reasons, because one, if there's a company in transition, the transition might not fully occur. That's fine, but you still, you know, would end up okay as long as they're not kind of, you know, spending excessively. So you still have an opportunity to make money even if the thesis does not play out. The second part of that is you want to have the ability, when they have a strong capital allocator involved, to take on debt, to make an acquisition, to grow the business, to make good capital allocation decisions. If you're already kind of levered up, your flexibility is significantly lower than it would be otherwise. And so the balance sheet to income statement investing requires a good capital allocator, because you want the companies that, whether it's an activist investor comes on, whether it's some sort of divestment or other company-specific situation that's occurring there, there's some decision making by a management, by the board, to reinvest the cash they might have into areas of higher potential. And so we want to kind of piggyback on that as a passive investor. And so again, you want the low amount of debt, reduces risk. You also want the low amount of debt in order to allow them to have the flexibility to take advantage of significant opportunities. You know, the real risks are this. The company may not fully complete the transition, and that's occurred in some cases. And you know, this is bound to happen, you know, with this type of investing, that, you know, they're looking for something based on incentives or hints or clues, and this is why it's cheap in the first place. And so, you know, I'm looking for things through like employment agreements and other things like that, or whether it's net operating loss carryforwards or other aspects of the company that are not fully being appreciated by the market yet. And then, you know, that might happen. Maybe there's a capital allocator in there that makes poor decisions, et cetera, et cetera. It doesn't always work out. We've certainly had some of those, and it's been fine. Sometimes we've lost money on it, sometimes we have not. But that is part of the risk. There's opportunities for value traps there. And then, you know, oftentimes, not often, almost every time, the investment's going to be a little bit early. And so that requires patience. Sometimes it's 6 months early, sometimes it's 7 years early. You know, we own Westate, we've owned it for a long time. Operationally, it's doing very well. I'd say it's made the transition from being a strong balance sheet type of company to actually showing its potential for predictable cash flow generation in the future. Same thing with MMA Capital, that's happened. where they've made the transition of a balance sheet type of book value, valuation type of company now, where over time, these people who are interested in growth, who are interested or investing for cash flow generation, for kind of other income statement characteristics, these are the type of investors that are going to come on board now once that transition occurs. But the stock price does not yet reflect that. And so we have to have patience to allow that to happen. And if we're early, that's okay. It's better than being late, for sure. And even going back to Bank of America TARP warrants that I owned for 6 years. I bought those when I first started the fund, and 4.5 years later, this traded at the same price. Traded the same price, and then this was before the election. The next month they doubled, and the next 3 months they doubled again. So it's a great investment, but it was tough for 4.5 years. It required discipline and patience and confidence in what the company was accomplishing. This is the type of thing. I think we're in the situation with MMA Capital, even though the price has gone up, and we're certainly in this situation with West Aim and Enterprise Diversified as well. That we have to give it time to allow the cash flow generation potential to go through. So MMA Capital, it trades at about $30 right now. Earlier this year, it came into the Russell 3000 index. Usually when these companies kind of get into different indexes, you'll see a pop in stock. I saw this with ALJ a couple years ago, about 4 years ago, where it increased in value from, it was a high 180s, $2 or so, $2.50, went up to about $4.80 a share within a short amount of time because it got into a Russell index. There was a possibility for that to happen with MMA Capital as well, but unfortunately it has not. Here we are at $30 a share. Book value's north of $36 a share. They've made a kind of a full transition from owning a whole hodgepodge of different interests, including a bond portfolio that's kind of maximized in value. They're transitioning out of that and have now, the primary business is a solar lending fund. They make short-term solar loans. They have a couple partners with that, and they have their balance sheet is put to work as well. They had a transaction as well with a private company that ended up buying shares at book value, which was even higher than today. Their average entry price was $33.50 a share for this private company. And again, the stock is down at $30. This occurred about a year and a half ago. And they now outsource their operations to this private company, Hunt Companies. Hunt Companies helps to source deals for them and also provides liquidity and provides some investment opportunities and kind of investable cash that they do through the solar fund. With that, MMA Capital has a pile of cash. They have a loan receivable from Hunt Companies that should, over the next few years, turn into cash. And they have a big investment in the solar lending fund that has been providing kind of double-digit, mid-teens unlevered returns. So it's a great business, and they've yet to have a loss actually in the solar lending fund, but I'm sure they will at some point in the next few years here. But they've been running it for several years. Underwriting has been very strong. Duration is very short. IRRs are very high. So we have MMA Capital trading at $30 a share. Book value is $36.20. We've got predictable cash flow of at least $3 a year. And we've got a pile of something along the lines of $90 million of cash and equivalents. So the risk here is extremely low. It is a very large position for us. But the opportunity, even for a minimum of 20% growth for the stock price itself over the next 5 years is very, very high. At the very least, it's getting to book value. If they were to liquidate today, for example, the book value is the value. Enterprise Diversified, talked about a little bit already, but go into some detail about the restructuring that we've done over the last year. So we had an ill-fated investment in a real estate entity called Mount Melrose. Very, very difficult situation that happened. We've now shedded the holding. We're limited partners in kind of sold the company. We're limited passive partners in what's left of it. We made this transaction with the chairman about a year and a half ago, and it was a major distraction for the company itself. And some of the decision making at that level, kind of this decentralized level, was poor. It did not work out well, and ultimately that's on me. Is that now I'm the chairman, although the transaction was with the chairman at the time. I was the CEO of the company at the time, and so that decision is on me, and we've spent the last year or so trying to clean up from that decision. And I think we're at the end of it. So we've written it down to about $50,000. So from here, we still have this limited investment, passive investment in a holding. We expect to see assets, kind of net assets from that once that real estate portfolio in Lexington is liquidated over the next year or two. But balance sheet writes it down to almost zero, and so again, I think there's more value there. The second part of restructuring over the last 6 months or so was home services subsidiary that also has not worked out well. We had that on our books for a couple $1 million, wrote that down to zero, but we get a revenue share over the next 5 years there, so we're expecting to recoup some cash. But with that, that's really been the main drivers of the stock price. I think we have 2 decisions that did not work out well over the last few years, and with that, the book value was written down significantly. Whereas I think we had some investors who invested in the company based on book value or a multiple of book value, which was fair enough given the situation with the company prior. And now that's a difficult way to judge the company, because the only book value that's kind of left is our holding in Alluvial fund. That's kind of an NAV, and we've written down almost everything else in terms of the book value side. So we get no value on the balance sheet based on the fee shares we received, the partnerships we've done and launched. And Willow Oak, for example, really gets no credit on the balance sheet side. And even we have this legacy business, internet business, that is on the books. Goodwill is $200,000, and it threw about $650,000 in net income off last year. So certainly it's worth much more than the $200,000 that it's on the books for. But all of these restructurings we've done in the last 6 months or so has allowed us to refocus and really commit to our highest potential subsidiary, which is Willow Oak Asset Management. I think without those restructurings, we would not have the opportunity to be launching new funds, to be partnering with funds as we are right now, to be holding these types of events. Because not only were those subsidiaries that we had to restructure financial issues, they were distractions from the corporate side. And we've been able to kind of get rid of that, focus on maximizing the value of what we have at Willow Oak and looking for opportunities to grow that. And I think we have a ton of opportunities. Our focus is to really partner with emerging managers. And we've got a great network of those unique emerging managers. They're value-oriented, they're bottom-up fundamental investors. And they're funds like myself, like Arquitos, like Keith Smith, like Dave Waters and others, like Scott Miller and some of the other funds associated with Scott and Greenhaven Road, where we've got kind of one-man investment committees. People came up, changed careers. They want this to be a 40, a 50-year fund. They have a long runway, and so we can take make ultra long-term decisions and bets on certain companies and portfolio companies. And that's really, I think, the only way you can have success over extended long-term time periods is to have that time duration. And as part of kind of all the affiliated funds that we're involved with, that allows us to attract investors that are like-minded, that are also looking for that similar time duration. Allows those investors who learn about one or more of our funds, who share that investment philosophy, to be introduced to others. And so we're excited about that, and we think we can continue to build a community of fund managers and investors and allocators and other things like that, who can be kind of circular and self-supporting over many, many, many years. I'll talk a little bit later about Peter Kaufman and his 5 aces when choosing a money manager, and that's kind of the way we've approached this in the funds that we're affiliated with. So we could not be more excited with what we have going on at Willow Oak. That's the focus of the company in the future, and that's really the growth opportunities. And the money management business, when you choose the right managers, is the best business in the world. We have the opportunity for a limited amount of expense up front to make significant returns over time for the managers, for the investors, and for Willow Oak as recipients of a fee share. And I think we can handle the operational side for funds. We can help make some introductions. This is, by we, I mean through Willow Oak. And we can show the infrastructure that's necessary to garner large allocations for funds. And most importantly, these are funds and people that we kind of like, we're already sharing ideas with, we like working with, and we like to have that relationship formalized. And that's what we've been able to do, and we look forward to expanding on that over the next few years as well. And the last one, West Aim, just a brief overview. They have two subsidiaries. There's an insurance company, and there's a credit fund called Arena Investors. The insurance subsidiary is likely to be sold or possibly IPO'd next spring. They've been looking at a restructuring over the last year or so, and essentially what's happening is the insurance company wants to grow. They want to grow on their own. West Aim wants to commit more capital, though, to its credit fund, and rightfully so, given the returns they've been able to garner there. The insurance company has been doing well. They've certainly been improving operations, combined ratios below 100. They've taken on more risk in the balance sheet and performed well on that over the last few years. And the insurance company's held on West Aim's books at 1.1 times book value. Book value is, I believe it's $3.20, somewhere around that per share for the overall company. But when the insurance company either goes public or gets bought out or has some sort of partnership as they go through this restructuring, it's likely to be, the actual value of the company is likely to be significantly higher than 1.1 times book. I mean, 1.5 times, somewhere around there is probably more of the proper value. But what we have now is a stock price at $2.50 a share. And we have book value at $3.20, say $3.22 a share, I believe. Book value is undervalued in and of itself, as I mentioned, because of the insurance operations. And then you have Arena Investors that just over the past year is now a profitable subsidiary. They've been able to build up their infrastructure. They have AUM now above $1 billion. They've hired Parag Shah last year to head up the marketing efforts. And from what I understand, that's been very successful so far, building the infrastructure necessary to raise several $1 billion. Parag used to be the head of marketing at Bridgewater. He knows what he's doing, certainly. And I know there's some partners involved that are assisting as well. So in the Arena Investors, their performances continue to be strong. So you have great opportunity with Arena Investors. Certainly that portion of the business itself, if they're able to get double-digit unlevered returns, it's certainly worth more than its book value. And the insurance company as well, it's possibly worth 50% higher than its book value as well. So looking at it from that perspective, at a multiple of book value that trades at $2.50, book value is $3.22. We should be at least $3.84 a share just based on book value itself. But I think what will happen over the next few years is you simplify the business, you get rid of the insurance operations, the credit fund continues to raise capital, it continues to show the type of performance and time periods, get another year or two under the belt, and then investors start to value it on the income statement side as part of the transition I talked about earlier. So with that, happy to open it up to questions. Anything about the portfolio companies themselves or about Willow Oak, if you have any questions as well. Jessica's out here with a microphone, although I might be able to hear you either way, but since we are recording this, maybe the microphone would be best. But yeah, raise your hand if anybody has any questions. My friend Lou.
Steve, could you give us your thought architecture on sell decisions? They're always painful, at least they are for me as an investor. And are these things you sit with? Do you bounce them off of your colleagues? How do you work through the decision to extricate yourself from something as opposed to having the patience to hold on to it.
Sure, so it's a good question from Lou, because each of us have a friend who treats that decision in a unique way by simply not selling. Our friend who runs a fund, a very, very long-term fund, and just simply never sells anything. And so that's one way to go about it, which actually is not a bad way of doing so, because what happens is when you have a company that's done well for you, and is a good capital allocator, or has some sort of good capital allocator involved in the company, it's likely to become overvalued over time. You know, we're looking for companies that are undervalued when we're buying into them, that have the potential to become overvalued. And then even when they're overvalued, but everything's clicking on the operational side, when you look back 5 or 10 years later, and say, well, okay, this thing was expensive, maybe it traded at 20 times cash flow or something like that. Do you want to own something at a 5%, free cash flow yield? Maybe not if we're value investors. But somehow those types of companies continue to trade at that valuation or higher and continue to grow every year. And this will make some special companies like a MasterCard or something like that, or a Costco, that it's difficult for us to buy into as value investors, because it never gets to a price we like. But we look back 20 years and, lo and behold, look what MasterCard did, or look what Philip Morris did, or these companies like that. And so part of it is adjusting what the definition of value is, and not being so kind of connected to Ben Graham in the 1930s. I mean, certainly this is a different world. And so buying into, we need to have some flexibility for buying into companies that might be kind of outside of some sort of orthodox. So that's part of it. But then, to the sell side is, I'd like to own it too long, quite frankly. The idea here is trying to limit permanent capital loss. So if we're buying into a company does well, we have a cushion there. If the stock does well, we can always take a little bit off the table as necessary just for portfolio management decisions. But you don't want to do that, if you don't have to. We have our friend Lou, friends that I referenced for Lou and I. He owns a company from the 1980s that ended up being the best performing company over the last 30 years. Returned, I think it was 24% a year, recently written up by the Wall Street Journal. And it became, I think it was in overall probably a $400,000 investment in 1985, let's say, and it's a $30 million investment right now. Never added another dime, never sold it. And so if you can find a couple companies like that, you're set. You find a Berkshire Hathaway, in 1974 or 1975. And I think for Enterprise Diversified as well, I think we have a long runway, 20, 30, 40 years. And there's time periods where it'll be overvalued. There's time periods where it'll be undervalued. We want to own it throughout because we like the business and we think it has the potential to operationally outperform over decades. Certainly, you would have loved to own MasterCard. So I think fundamentally, though, if you know you made a mistake in your analysis, whether you made money or not, that's a time to exit. If it is a situation where valuations get extended to such a degree that you just can't justify relative to the growth opportunities or risk associated with it, I'd say we make less of those decisions based on wanting a certain percentage of cash in the fund or having some sort of any kind of macro opinion. I think macro opinions generally only work in hindsight. And so if we're bottom-up investors, that's not something we're especially good at anyway, but two, neither are they. The macro people aren't very good at making predictions either. So I think if you make a mistake, if there's something along the lines of extreme overvaluation, if it's a portfolio management type situation, and typically what happens if things are going well, you're having a great return, more money is flowing into the fund, those positions become smaller percentages of the portfolio naturally over time. More difficult decisions are things like over the past 18 months where we've had challenges in Arquitos and received a few redemptions and the AUM has decreased. Well, then what do? Which holdings do you want to continue to own and which not? And for me, that's actually made me, I think, more concentrated in the best ideas that are the most undervalued. And that's why you come out of 2015 when I had a down year. We come out of 2018, 2019 here, where the portfolio is in the best position to outperform than it otherwise would have, if not for some of those adjustments. And, you know, again, you have some redemptions. Which one are I selling? Well, you know, I'm selling some things that I'm not as committed to do that. And that's why an MMA capital becomes 35% of the fund, you know, like it is right now. So next year you have MMA capital that's declined, you know, kind of since the beginning of the year, it's declined a bit. But at a minimum, you know, worth 25% more kind of day one today, and over time has that continued potential. And so, and the risk is extremely low. I mean, it's very strong balance sheet, great partnerships, et cetera, et cetera. It's exactly what you want to own in a concentrated manner. And you know, that's kind of where you're at. But other than that, I think it's, you know, ramble on, I guess we talk all day about you know, the different selling examples and things like that. But there's no set way, and I don't think there's a formulaic, quantitative way, or I don't think you want it to be that way either.
I wonder if you can elaborate a little bit more on the mistake of omission, that case of Belmont.
Sure.
Is it more, I mean, I guess the fact that it worked out really quickly, there's some luck involved. Is your mistake more result-driven or process-driven? Meaning, have you identified any issues in your decision-making process, rather than as, you know, being judged by the outcome?
Yeah, so the catalyst actually did not involve luck. That was in the filing. So the founding shareholder, James Sherwood, he's now 85 years old. He had owned the company all along. He had a poison pill type of position in the company that had value to it. And so the company was never going to get sold while James Sherwood had this kind of poison pill. And the idea was he could buy back Hotel Cipriani and things like that. He could buy it back personally if the overall company sold. So the company was never going to sell. And when you think about a luxury kind of hotel and travel company, you know, they need to be a part of a network. You know, we saw with the Marriott Starwood mergers, and you know, we have certain mergers that are based on kind of you know, there's offers by kind of the Saudis and things like that, and in the Middle East, and then some of them are strategic mergers. But you have to have those networks and connections to get full value. And so you had Belmont sitting out there as an independent. So if not for James Sherwood and his connection to it and his poison pill kind of aspect, probably would have sold 10 years ago, 15 years ago. The value would have been maximized from that, or they at least would have sold off the pieces. But what happened was he's, you know, getting older. He had some health issues. An 8K was filed that said he was going to do away with the poison pill, was selling it back to the company for value. And then if the company was sold in the next 6 months, Sherwood himself would get a $25 million payout. And the board itself were his hand-picked friends. They'd been there for many, many years. He made that decision. That 8K was filed. I mean, he made that decision knowing they were going to have a deal. They had gotten valuations from, I think, 2007. There was an offer for $60 a share. And at the time, this is trading for about $10 a share. So the analysis was, well, it's worth $15 to $20 from a strategic buyer, you know, from a Marriott or from a Hilton or something along those lines. But because of the holdings that Belmont had, it was highly likely that you would have some sort of a luxury type of buyer, you know, a sheikh, for example, come in, a sovereign wealth fund or something like that, or what happened like a Louis Vuitton. So, you know, obviously Louis Vuitton is not a travel kind of oriented company, but they bought Belmont as a luxury brand, not as a travel oriented company, and because they knew the value of Belmont's brands. And so the thesis was, okay, it's trading at $10, $11. All this information has come out. Not widely known, but it came out that it was definitely going to get sold in the next 6 months. I mean, that's a 95% chance. Otherwise, he doesn't sell his stake back. He doesn't have a clause in there that he gets paid $25 million if it gets sold. And so, you know, this is some of the clues of what's been the discussions the last few years in the boardroom, you know, that we don't know about as passive outside shareholders. So you knew it was going to get sold. You knew it was going to get sold for at least $15 to $20. And, you know, we saw Starwoods a few years ago had a bidding war, you know, that happened. There's more than one player out there looking for these acquisitions. And I don't know how many bidders were associated here, but my guess is there's a significant number of them. And, of course, Louis Vuitton was the one that owned out. But, you know, it's worth $15 a share at a minimum. Trades at 10. and ended up kind of getting sold out for 25. And so the mistake of omission there was, I knew all these things. It was public. You had the catalyst. And I did the same thing with Intra-West Resorts a few years earlier. It was a similar situation that you knew it was going to get sold. You knew it was going to be at a premium. They had made these internal decisions that all the catalysts were in place. So I think the takeaway for me was, and this is going to happen occasionally. You have mistakes. Nobody bats 1,000 here, but the issue was for me making sure that not dilly-dallying around. This happened 3 months later after kind of Thomas's write-up. They still had a couple more months left before that 6-month time period hit. Certainly could have bought. I don't know if I would have bought it in that next couple months or not, but there was kind of the time of year I was focused on the current holdings. I wasn't kind of open to other things. I was reading things, but not. I extended conversations with Thomas about this, but did not kind of take the next step and actually buy a position. So, I think the stake there is when you have an obvious one that this was obvious. I knew it was obvious at the time too. Do it. Don't mess around. Do it. Doug?
Thanks, Steve. I have a question on MMA Capital. I guess we're about a year and change in from the Hunt takeover of
Sure.
MMA. Prior to Hunt's acquisition, one of the secrets of MMA's success was significant share buybacks. Now that it has a management company that might have a desire to have greater assets under management than buying its own shares back and taking part of its lunch out. Where do you see the advantages of Hunt's operation, and is that enough to overcome, or how do you see the alignment, perhaps is the question I should be.
Yeah, no, I mean, the share buybacks were a significant part of the thesis. They bought back 10% of the year, 10% of the outstanding shares per year for, I think it was a 6 or 7 year time period. And they always bought it back below book value, so it was accretive to book value, this is perfect. This is the type of cannibal. This is why it rose from $12 to $30 over 5 years, all based on book value growth and off-balance sheet book value kind of coming on. They have this tax loss carry forwards as well, so they don't pay taxes. So I think the difference here, and this might be one reason I think why the stock price might have stagnated the last few months. Once they got into the index, they stopped the buybacks. My understanding is they may start them up again, but now that they're in the index, they need a certain amount of liquidity kind of to stay in it, and they want to grow the business. They do, and I think we'd love to have them grow the business. Right now, they're allocating any excess cash that they have to direct investments in their solar lending fund. That's the type of opportunities they see there that are greater than the opportunities they see with the share buyback. They certainly could do both, but having discussions and others who are associated with them, that's kind of the understanding that they think they can do 15% a year, unlevered and on the solar lending side. Now, if it trades at 30 and this, book value is 36, it's 18% a year or something roughly of 20% a year of kind of safe, obvious buyback returns too. So there's the give and take. But my other understanding is there was a reason why they have not been able to buy back shares recently. There's kind of some behind the scenes things going on. So I think let that play out. I'd be surprised if they don't buy back some shares in the future again, but I don't think we're going to see 10% a year forever. Otherwise, we go private, whatever the case may be. I don't know how much of it is connected to Hunt companies either, quite frankly. I mean, I think there's a liquidity issue there for outside shareholders. We can only own up to 4.9% of the shares, and Hunt companies owns more. There's a poison pill in place associated with the tax loss carry forwards. But I think Hunt wants to own wants to grow the company as well. I think it's Christopher Hunt who is kind of the leader of the acquisition or the transaction there. He's bought a significant amount of shares personally and for his wife's retirement account of MMA Capital. You know, so I don't think they'd want to do that if there's an idea that, one, it could go private, or two, that he's not seeing tremendous value there when they already have a very large position. Now he's doing it personally through his wife's account too. You know, you want to be very sure about that. So, you know, remains to be seen, but either way, you know, I don't think we've seen the end of it on the share buybacks. What are they going to do with $90 million cash either? You know? They put 50, 60, 70 million of it to work at 15%. I mean, that share buybacks will be the least of our worries at that point.
I wanted to ask about Enterprise Diversified
Sure.
owns alluvial shares. I wanted to hear, how do you deal with the conflict of layers of fees? I mean, alluvial has its own layer of fees, you have and then you have your own layer of fees, and then Willowbrook, I'm not sure how do you deal with all those conflicts of interest? I mean, in your presentation, even though your returns were good, it jumps out that basically the difference between the net and the gross is almost 6% at this point.
That's all from performance fees.
Right. But I mean, 6% is still a pretty large annualized number. Okay.
We've had large annualized returns.
Huh?
We've had large annualized returns. So, you know, that's part of the performance fee. Of course, you do very well, and that's where there's alignment there. You know, I say that, you know, just kind of jokingly, but no, I don't dismiss the fact that there is a difference there. But those are from performance fees. And let me kind of describe the relationship with alluvial a little bit, and you know, happy to kind of answer a follow-up to that. So I don't have a flow chart up here, but basically what happened was Willow Oak Asset Management, we seeded alluvial fund with $10 million January 2017. And Dave's done very well, of course, and we want a permanent relationship with him. The way that it works is that Willow Oak pays management fees, but not performance fees for that portion of the investment. And then we have a fee share with alluvial. It's been undisclosed. And it's based on, it's a little bit complicated with several different factors. So then when we, so that's the ongoing permanent, you know, Willow Oak is a relationship with alluvial that obviously we want to last forever. We think we can continue to be good partners to Dave. Dave's been great partners to us. And you know, it's a significant driver of the Willow Oak thesis. That we get a return from Dave's returns, we get a return from the fee share, and we prove out the model with Willow Oak in order to attract additional managers who are similar. And we want to continue to build on that. So there's a unique aspect, though, associated with Arquitos Capital, and that is about when we started the Mount Melrose acquisition, and we had some regulatory kind of issues as well at the public company, Enterprise Diversified. We withdrew $3 million from alluvial fund. Willow Oak withdrew $3 million from alluvial fund, and we replaced it. I replaced it with Arquitos, and so Arquitos pays a management fee, but not the performance fee. And then the fee share, though, goes to Enterprise Diversified or to Willow Oak. And the reason for doing that was, you know, it's kind of a complicated model that I built out and said, well, what's the best way to maximize the return for Arquitos? And, you know, it's kind of an inexact science, but that was the decision making behind it. It also was not going to be and is not going to be a permanent situation. You know, it was to assist Willow Oak during the time of transition with Mount Melrose and the acquisition. And so, so the layer of fees, I mean, look, Arquitos paid $45,000 in fees last year to alluvial. It's a minor amount from the overall AUM. Our AUM last year was $32 million. You know, we paid $45,000. It's not nothing, but it also is not material to the overall returns. And the fee share that allowed Willow Oak to retain a higher level of fee share than it otherwise would have, if not for that replacement, in my opinion, was worth it. Now, looking back, the idea was it was not going to be, you know, it's been longer than it otherwise was planned to be. We initially were planning on replacing it within 6 months because we were going to be able to borrow against some of the real estate and use that cash to put back into alluvial on behalf of Willow Oak, and have Arquitos kind of extricate itself from the alluvial holding. And but because the real estate portfolio performed so poorly, we were unable to kind of secure that loan that we otherwise were planning on receiving. So we've had discussions at the board level and how to kind of right-size this and extricate that investment from Arquitos, and certainly Dave and I will have some discussions as well with alluvial. But right now it's benefiting Willow Oak, which in return benefits Arquitos. And remember, we're a 30% shareholder in Arquitos is a 30% shareholder in Enterprise Diversified. So what's good for Enterprise Diversified is good for Arquitos and Arquitos' investors. There's a judgment call along the way of the best way to kind of do what's best, for all parties involved. Is there, the question of a conflict of interest or not? I guess my view of it is, again, what's best for the public company is best for Arquitos investors. And the additional return we get from the fee share is better than not having it at all. We're figuring something out at the public company level to kind of move forward with that. But we want the permanent relationship with Dave. We want to be permanent kind of foundational investors in alluvial. And Arquitos was able to assist in a small way last year, and we'll see what the situation is going forward, though. And I'll say, one thing I want to mention. I have a friend who launched an ETF earlier this year, and there's some opportunities to kind of launch ETFs, closed-end funds, things of that nature. Not anything we have on the horizon at Willow Oak, but if we had someone launch an ETF. My friend who launched an ETF, he earns fees from it through, I won't name it, but he's probably a name that most of us recognize. There's fees associated with that. If I invested in as an ETF, would that be a conflict of interest? I don't think it's somewhat similar in this case, except for the fact that we get a higher return. We get some of those fees kind of kicked back to us, fee shares kicked back to us. And if you think the portfolio of that ETF is an attractive portfolio to own and to have, then you make the investment. I think you just do it. And your Arquitos investors are kind of investing not in any one particular company that I own, but in my judgment over time, right or wrong. And that's kind of part of the judgment. And certainly, we have a unique relationship with the public company, and that will continue.
Do you have any special situations coming up you're excited about, or potential situations coming up?
I wish I could go back in time and say Belmont, certainly. But no, look, some of the current holdings, I'll just mention another company that I own that's called Pendrell. Pendrell was a public company, very large company, went not very large, but larger than most of the companies we own. Ended up kind of going private, still trades on the pink sheets, and I retained my shares. And it's sitting there trading for less than its net cash, massive net operating loss carry forwards, great partners involved. Experienced capital allocators, et cetera, et cetera. Jeff wrote it up a year ago, and I think has followed it for quite some time, Jeff Gannon. And, I owned it before it kind of went private, and continue to own it. And it's, again, it's public. By went private, I mean deregistered from the SEC, and it trades on the pink sheets. It's a special situation that's interesting and attractive. Shares trade at $157,000 a share right now, so depending on what type of allocation you'd like to make. If you buy one share, you can request the financials from them. It's been private. So that's kind of interesting, and it's a situation where I'm willing to sit on it. We actually get a valuation opinion for Pendrell, just to kind of let you know how we value that. We generally value things at the bid if there's not been a trade. This one trades a little bit, but not a lot, and so we get a valuation opinion done for that, and that's how we mark it. So it's kind of set at one price. But it's going to kind of register again with the SEC, I think, in the next year or two, and you're going to see an opportunity where, in the course of a day or two, it'll double or triple in value, I think, as they make an acquisition. And then, honestly, the company I'm most excited about, absent Willow Oak and Enterprise Diversified, is MMA Capital. At this price, it's the lowest risk, highest potential return investment that I've seen.